How smart investors build $1,000. We've all been told that the key to wealth is finding a shortcut, a quick win, or a fast return. But the reality is that mindset often leads to frustration and fleeting results. Just like trying to build a house without a strong foundation, quick gains rarely last. What truly separates the wealthy is a more patient, methodical approach, one that values steady, thoughtful decisions over immediate rewards. In this video, we'll uncover how smart investors build lasting wealth through consistency and clarity, piece by piece. Number 1. The brokerage account you choose is your first tax mistake. When most people think about investing, they focus on the stocks, bonds, or assets they choose. But the account you use to hold those investments is just as important. Many people open a simple brokerage account, believing that their investment choices will do the heavy lifting. But in reality, the wrong account can erode your returns before you even get started. For example, if you're investing in a taxable account, every time you sell an asset for a gain, you'll pay taxes on those profits. In contrast, using tax-advantaged accounts like Roth IRAs or 401ks can shield your gains, allowing them to grow without the tax burden. The wealthy understand this difference well. They know that the right account doesn't just house their investments, it helps their wealth grow more efficiently. Understanding the impact of this simple choice can change the way you approach investing. Number 2, harvesting losses to manufacture growth. When most people think of losses, they think of setbacks, something to avoid or fix as quickly as possible. But wealthy investors have a different relationship with loss. Rather than seeing a loss as an outright failure, they see it as a tool for growth. This is where the concept of tax loss harvesting comes in. Tax loss harvesting is the practice of selling investments that are underperforming in order to offset the gains made elsewhere in your portfolio. While most investors hold on to losing investments in the hope they'll bounce back, the wealthy understand that losses, when used strategically, can minimize taxes and maximize future growth. Think of it like tending to a garden. You prune back the dead branches, not because they're failures, but because doing so allows the healthy parts of the plant to thrive. By strategically cutting your losses, you create space for your portfolio to grow, both financially and strategically. The true value of this mindset is that it goes beyond just reducing your tax bill. It's a disciplined approach that frees up more capital to reinvest and focus on what's really working. This reframes loss as an opportunity, not a setback, and that's where the wealth building magic happens. Number 3, the barbell strategy for asymmetric returns. The barbell strategy turns traditional diversification on its head. Instead of balancing risk evenly across your investments, you focus on two extremes: very safe, low-risk assets on one side and high-risk, high-reward opportunities on the other. Most investors spread their capital across the middle, moderate risk assets, but this often leads to mediocre returns. Wealthy investors know that true growth comes from maximizing the potential of asymmetric returns, low-risk stability paired with high-risk, high-reward assets. Imagine a barbell at the gym. On one side, you have heavy weights for safety, on the other, light weights for growth. This strategic imbalance offers the potential for outsized returns while keeping your downside protected. By focusing on extremes, you don't just grow your wealth, you build it more efficiently with greater potential. Number 4, using debt as a strategic inflation hedge. Debt is often seen as something to avoid, but when used correctly, it can be a powerful tool. Specifically, it can act as a hedge against inflation. As inflation rises, the value of money decreases, but debt, particularly fixed-rate debt, remains the same. Borrowing at low rates means you're locking in cheaper money today, and in the future, you'll repay it with money that's worth less. Wealthy investors understand this dynamic. They use debt strategically to buy assets that appreciate in value, all while benefiting from the devaluation of the money they owe. Think of it like buying a house with a mortgage. The house appreciates in value, but your payments stay the same. Debt, when used with intention, becomes a tool that amplifies your wealth while inflation works in your favor. Number 5, the liquidity trap of over-diversification. Diversification is often seen as the ultimate risk management strategy, but overdoing it can lead to a dilution of returns. Many investors believe spreading their money across dozens of assets reduces risk. In truth, it can trap their wealth in underperforming investments, offering little to no real growth. Wealthy investors know that true diversification doesn't mean quantity, it's about quality. They focus on fewer, higher conviction investments that align with their goals, rather than trying to cover every possible risk. Over-diversification can leave you spread too thin, unable to capitalize on the best opportunities. Instead of managing risk, you end up managing complexity. The real strength lies in concentration, not in excess. Wealth is built when focus and intention guide your decisions, not when they are diluted by unnecessary choices. Bonus point: automate your worst performing investment first. When it comes to portfolio management, it's easy to focus on the winners, the investments that are performing well. But what if you could take a different approach? Automating the sale of your worst performing assets first forces you to confront inefficiencies in your portfolio without emotion or hesitation. This practice not only removes the burden of decision making, but also helps clean up your portfolio, freeing up capital for better opportunities. By automating underperforming investments, you're ensuring your focus stays on growth, not on holding on to what's not working. It's a simple yet powerful act, removing the clutter and creating space for what can truly thrive. This approach isn't just about managing money, it's about managing your time, your energy, and your focus. And that's where real wealth begins. We've explored how smart investors don't just chase quick wins, but embrace patience, strategy, and methodical growth. From understanding the power of tax-advantaged accounts to using debt as a tool and mastering the art of strategic diversification, each principle builds on the other, leading to lasting wealth. If any of these ideas resonated with you, take a moment to reflect. What's one shift you can make in your financial mindset today? Share your thoughts below. If you're ready to learn more about making smart decisions and thinking like a wealthy investor, don't forget to subscribe for more thoughtful lessons on building lasting wealth. Send this video to someone in your life who might benefit from a more thoughtful approach to investing. Stay tuned for our next video, where we'll deepen our understanding of building wealth step by step.